Hello and welcome to Livewire's Fund in Focus. My name is Chris Conway. Today I'm sitting down with Scott Kelly, who is the CEO of Real Asset Management. He's going to be talking to us about their new income offering, which is set to be listed on the ASX in October. Scott, it's great to see you again. Thanks for sitting down with Livewire.
Thanks very much for having me again.
Scott, can you tell us a little bit more about the RAM secured income notes? The ticker is RAMHA. What does it offer for investors?
So the notes are structured to provide investors with direct access to Australian mortgage credit, which has traditionally been the reserve of institutional investors. They're structured as a bond. They're senior, they're secured, they pay 3% over 1 month BBSW, and that income is paid monthly. They've got a call date of 5.5 years with a legal maturity of 6.5 years, which means they have a natural pull to maturity, meaning that creates capital stability.
So how much are you looking to raise, and can you talk us through the investment strategy?
Great. Well, we're looking to raise between $150 million and $300 million, and that will be invested in secured loans to gain exposure to diversified pool of mortgages and securitized investments. In terms of the mandate parameters, for the underlying loans, we exclude second mortgages, and at the time of portfolio inclusion, the 30-day arrears of those loans must be zero. To use your phrase, a real key point of difference is that we originate the loans ourselves through our non-bank lending subsidiary, Brighton Home Loans. That means two things. Number one, that gives us end-to-end ownership of credit risk. Each one of the 7,200 odd loans in the pool have had a real human credit officer in our firm review the borrower, their situation, and approve the loan, or otherwise. Two, we're not buying credit exposure in the market. We set the rates for the loans, so we are the price maker, not the price taker. Last but not least, we don't mark our own homework. Notes will have an implied credit rating from an independent credit agency, and their report can be made available to wholesale investors.
Scott, tell me where the underlying loans will come from.
They come from Brighton, which has built up a network of over 17,000 brokers across the country and currently originates about $270 million of mortgages per month. Since inception in 2017, we've written over 10,000 loans and have maintained a strong track record with arrears that compare extremely favourably to industry averages.
Scott, there's a lot of choice for income investors out there. So how does the RAM Secured Income Fund stack up against the other opportunities out there?
We believe the notes offer a compelling risk-adjusted returns for investors seeking regular monthly income with a big focus on capital preservation. The net yield on issue will be 6.55%, and if you look at the other investment grade fixed income products in the market right now, it's right up there with the highest yields available. Of course, it's not all about returns. We should really think about risk and how it compares to other products and find out exactly what investors are getting themselves into. If you look at the listed environment and the credit space within the listed environment, a lot of them are not senior secured loans. They may be property development, corporate loans with limited security, or even debt in a foreign currency. They can involve leverage and can lack transparency. In contrast, our notes have none of those exposures, and our structures aimed at being simple, secured, alternative to traditional fixed income investments.
Scott, tell me more about how you're structuring the notes to protect investors from risk.
So the notes have a range of structural protections and enhancements for investors. In addition to the certain maturity date that I've mentioned, the notes are secured with an independent note trustee taking security over all the assets of the issuer. Investors also benefit from the additional credit protection, with RAM providing the first loss subordinated capital of $10 million, which ranks below the listed notes. This will act as a kind of buffer in the unlikely event of a capital loss on the loan portfolio. And then if you look at the underlying exposure, each individual loan is fully verified in line with our conservative credit policy, and the first mortgage security is taken prior to approval of a loan, ensuring only high quality loans make it into the investment universe. The average LVR is below 65%, and we don't have any exposure to property development finance. We're also a big believer in diversification. Currently, the overall Brighton portfolio is more than $3.7 billion and is comprised of over 7,200 home loans, meaning the average home loan size is about $500,000, so highly diverse.
A big consideration for investors, Scott, understandably, is, will I get my money back? So just talk to me a little bit more about the liquidity.
Sure. The first thing I would say on this topic is we have a track record of paying people back in the institutional market. Brighton is supported by 8 Australian and international banks, who provide warehouse funding. Some of those have been in place for over 5 years and have supported us as we've grown the business and performed deep and continuous due diligence on the loans, our people, and our processes. So once those warehouses are large enough, once they're full, we securitize those loans by issuing RMBS bonds into the institutional market. We built out 3 RMBS programs supported by over 35 institutional investors, which are drawn from Australia, UK, Europe, Asia, and the US. To date, we've raised over $3.6 billion from those institutional investors via 7 RMBS deals, and every transaction has been called at its first call date. Secondly, it's a relatively small piece of a big pie. The notes at 300 million, say, represent only about 5 weeks worth of origination, or around about 8% of the loan book as it stands today. And as we grow that loan book, the percentage will obviously fall. So it's not an onerous task when you take into account the broader picture. We believe the warehouse relationships alone will ensure there's more than sufficient funding available to meet repayment of the notes at maturity. But in addition to that, we also have our unlisted credit fund, which are now around $400 million, and they'll probably continue to grow over the next 5.5 years also.
Scott, tell me a little bit more about RAM's track record, and perhaps most importantly, do you have skin in the game?
Well, the short answer is yes, we do. But I guess there's 3 track records that are relevant. Firstly, a track record of execution. We've been building the mortgage business for 8 years now, successfully originating, approving, processing, servicing, managing, and funding those loans. The team is both experienced and numerate. We have over 200 people in the firm now. Secondly, a track record of the loan book. We haven't lost a dollar since inception, as I mentioned. The stats like arrears tell you that the loan book continues to perform well. Thirdly, the investment performance of the unlisted credit funds. We have an 8-year track record of delivering returns above BBSW plus 3% with 0 capital losses and no drawdowns. And in terms of skin in the game, there are a number of features of the product and our firm that ensure we have strong alignment with investors. Within the structure, RAM holds the first loss piece of $10 million, as I mentioned, meaning that we will suffer the loss before any investors. Below the note structure, there is additional credit enhancement from equity notes supporting the warehouse and RMBS funding. More broadly, within the pool, RAM's profits are also at risk. And finally, RAM is 100% staff owned. So when we talk about being on the hook or skin in the game, it's our money at risk in these transactions first, probably why we haven't lost a dollar in 8 years.
Scott, let's zoom out a little bit. What is it about the current environment that makes it a good time to raise capital?
So one of the features of our firm is that we tend to build products with attractive yields. That's important in the context of an aging population that is still so-called yearning for yield. Additionally, APRA's decision to gradually phase out the AT1 bank capital over the next 7 years means there's around $43 billion of capital searching for income-focused products. Finally, the current rate environment means that fixed income returns remain attractive. There's multi-year highs in terms of base rates and absolute yields, with a higher for longer theme playing out. So we think it's a good environment to launch right now, but you might ask why we're doing this from our perspective, particularly when we could simply just continue to access institutional capital at a cheaper rate. Well, it's really twofold. Having a diverse range of funding and liquidity available for our credit business makes a lot of sense to us, and we want to broaden out our asset management client mix and reach new clients with what we believe is a really attractive product.
Scott, last one, and perhaps the most important one. Where can investors find out more about the notes?
Thanks, that's an easy one. Well, the prospectus and the TMD are available on our website. And if the viewers have any question on prospectus, the offer, they should, of course, seek advice from their financial advisor.
If you enjoyed that Fund in Focus, make sure to give it a like. And don't forget to follow our YouTube channel. We're adding lots of great content every single week.